What's up, guys? Thanks for tuning in. Now, if you take a look at this 15-minute chart, you can see how the rate of price change kept shifting here. This was in reaction to December's CPI report, which reflected a better than expected reading, raising hopes that the Federal Reserve could decelerate its interest rate hikes. Obviously, I'm referring to the January 12th future session. What I'm looking to see in this particular chart here is confirmation of market bias, either to the upside or the downside. And now, if price rises above CPI's induced levels here, it would suggest an incline in market trends. On the other hand, if price drops below them, it would imply that we can expect to see a decline. That said, however, we can sort of sense the market's price tendencies here by examining this lower high and then observing the formation of a sideways action alongside with the print of this higher low. Overall, these key levels do suggest that price could stay within its current range, at least for now. It should be noted that while this information may not necessarily confirm the market's directional bias, and I say this excluding this prompt balancing reaction to this nosedive move here, because if we include the emergence of this sharp balancing counter trend in our hypothesis, then the confirmation thesis is obviously a no-brainer. The question would be why? Well, because the assertion here is that once a counter trend momentum appears in a downtrend market, most of the time, the market's tendency is to make a reversal movement, setting a bullish trend. But again, while these technical propositions I just mentioned may not confirm the market's bias, they do at the very least, in my view, point toward the potential for a high probability trade opportunity. The reason I say this is because if we apply to this analysis Wyckoff's price movement phases, we can clearly see how the price went through a distinct cycle, beginning with a distribution phase here, followed by a decline and accumulation phase after supply apparently exhausted here before we jumped higher. In fact, and as this price action here shows, we have a reaccumulation segment taking place, which involves profit taking and acquisition of additional shares. Consider the identification of these segments as stepping stones towards the higher price points. And another thing here is that once you grasp the concept, you will find yourself looking for reaccumulations on a chart first. Now, if we take into consideration these patterns of price behavior, they can give us valuable insight into future market activity. Obviously, with no lower level inefficiencies to be resolved, this imbalance area here now becomes not only a point of interest, but also my entry point. So clearly for me, the market's pullback into this level right here is the confirmation I was looking for. And obviously, if I'm correct in my approach, what should follow is a short-term dominance of demand over supply. Now, oftentimes, I will opt for a 1-minute time frame to refine my entries. However, in this particular trade, the 15-minute chart seems like a better option. So I'm only going to use a 1-minute time frame to place my long entry and obviously set my price targets, which should hopefully validate what I spotted on the higher time frame. In my opinion, short-term trading is one of the most profitable market practices. Not only do you have a wide range of opportunities to take advantage of, but with consistency come numerous trade setups that can increase your earnings opportunities.
Target filled. Target filled.
Alright guys, that should do it for today. If you found this video helpful, please give it a like and subscribe to the channel. I would really appreciate it. Thank you and hope to see you in the next one.